We are actually looking at the corporate governance again, part two of the corporate governance. So, part two of it. If you remember, when I was discussing the UK corporate governance, the 5 pillars of the UK corporate governance, the first one was board leadership and purpose. Board leadership and purpose. The second one was division of responsibility. Division of responsibilities. The third one was board composition, succession, and evaluation. The fourth one is what I'm coming to go in today to do, which is internal audit, or let me say internal control. You can also say internal audit. So internal control or audit, risk, and audit committee. And that is so actually the pillar says control, risk, and audit. So that is it. Then the last one, 5, was remuneration. Remuneration. So in that video, in the part 1, we discussed all these things, and I intended to cut my audit video because these are what we learn in audit. This thing we learn in audit, corporate governance. And so I'm actually going to focus on only this one for us to talk about it. So let's pick it and discuss it because it's a very key component of internal audit. It's a very, very key component of corporate governance. Sorry. So let's look at internal control, which is very practical. We all know in all entities it happens. Internal control, risk, and audit committee. All right. Now, one thing you must understand in all this corporate governance structure that we are doing is that it's a very simple analogy, and I'm going to take it from trying to let you understand the whole thing of corporate governance. So, I'm supposed to discuss with you the agency theories. Okay, so agency relationship and theories, and we will do it today as well. So I'm coming to do this one. Then when I finish, I will do the agency relationship theory. Then we are end. We come to an end of this whole corporate governance issue. Okay, so basically that is that. All right. So the first thing I'm going to let you understand is that we all know that a company as it is has owners. We all know company has owners. Now these owners are called shareholders. We all know that. And from the day I made you join the financial management class, if you remember, the thing is that when you pick these owners, another name you can ascribe to them are principals. Okay, they are principals. And if you remember, what will happen is that these people have created their business, and what they are interested in is what we learned in the financial management class. We call it shareholder wealth maximization. Okay, shareholder wealth maximization. And if you remember, we said shareholder wealth maximization is defined by what? The dividend they receive plus the change in share price. You remember P1 minus PO. So it's either they collect dividends, which is cash, and if you remember this one, we talked about bird in hand theory, cash. So the person is giving the money. And the share price one, we spoke about what we call dividend irrelevant theory, if you remember. So this one is bird in hand. And this one is dividend irrelevant theory. We've already explained that. So anybody who you have to go back and watch the fundamental videos of financial management, you get this. Now, these are the owners, and this is what they are looking out for. This is what they are all looking out for. All right. Now, this thing starts, and clearly, if you have seen if you have observed life is such that these people, they start as sole proprietors. So at a point, the owners are equal to the managers. They manage it themselves. Everybody starts like that. You manage it yourself. Even if you go to the registrar general right now to say you are establishing a company, you know that you are few people, two people be, then you start. You will be managing the thing yourself. But thank God for growth. When business starts growing, then you start delegating some of the duties to some people. That's what happens. You start delegating some of the things to some people. So because of that delegation that you are doing, you decide to become a limited liability company. Because what happens is that you are handing over the thing to some people, and because you are afraid of what they will be doing, the liabilities, you want your liabilities to be limited to how much you donated. Other than that, somebody will misuse your own resources and you will be held responsible again. How annoying that thing is. Yeah. Somebody will do that and you will be you'll be held responsible again. That's what happens. Yeah. That's what happens. That's what happens. So when these things happen, they keep it as limited liability companies. That's what they do. And in the limited liability companies, you realize that they pick up managers to manage the company. Now, that is where we are looking at these people, the owners, now brings in the managers. The managers, we call them the board of directors. And in the first video, I think I explained the difference between board of directors and management. And the fact that in terms of nouns, they are different, but in terms of verb, they all do the same thing. So they pick up board of directors, and these board of directors are actually agents, and their job is to manage the business. I think this thing is a basic thing we all kind of have an idea about. All right, so that is that. But unfortunately, as these people are looking for shareholder wealth maximization, the chairman, the people here, their objectives are different. What they are looking for is profitability. So there is a difference in goals. Profitability. They want to make more profit. Why do you think CEOs and the board of directors wants to make more profit? It's a very simple idea. Because they want to get more bonus. They want bonus. That one there, even we are all like that. So we all know that profit is short term. It's short term. These people, they want their cash. Profit is not cash. Profit is arbitrary. Because you can have a business, you are making more profit, but you never had cash. So you see, these people are in need of their cash. But these people, because they want more profit, they can do more credit sales because for them it is about profitability. It's about profitability. So you see that, and sometimes too, they move to their objective is to build an empire building. Yes, so they want to be the CEO of group of companies, like that kind of branding they want to attach to themselves. So the problem here is that we have owners who have employed these people. They have employed them. The owners who have employed these ones to work on their behalf so that they will report to them. This is what happens. Now, as things stands in this diagram that has drawn to you, there is a problem. And the problem being that I'm just explaining to you the whole thing of agency relationship and stuff. And I will gear it towards the internal control risk and audit committee so that it's okay. We can drop it there. Now, because these people have different goals, it creates what we call the agency problem. It creates the agency problem. Agency problem. Now, the relationship that I've established here, that this relationship, a situation whereby we have owners and we have agents. So this relationship is called the agency theory. Agency theory. That's what it is. Another name for this one is called separation of ownership and control. So we have a situation whereby the owner owns it, but he cannot control. And the one who is controlling it doesn't also own it. That is how it is. All right. So because of these differing goals, we have an agency problem. Now, what is the cause of this agency problem? Clearly, you can see one of the major causes that we have seen here is lack of goal congruence. Lack of goal congruence. Clearly, there is different goals. Another cause of this thing is what we call information asymmetry. Information asymmetry. Now, what is information asymmetry? Information asymmetry is a very simple thing. It says that information is one-sided. Now, if you look at this one, information is with the board of directors. They have everything. That's why they prepare the financial statement for the owners. So they have every information. And until they communicate it to the owners have no idea. So we call it information asymmetry. And that is the reason why I always say that's the reason why husbands ask their wife, how was your day? They just want information. They just want, and the reverse is the case. We all want information because information is one-sided. So we would want you to communicate well. So this one, the different lack of goal congruence and the information asymmetry is a major cause. And to solve this problem, is the agency. So this problem is called the agency problem, as you can see. That to solve this problem, it will cost the company. Solving this problem is what we call the agency cost. The cost, you see, it will cost the entity something when there is an agency problem. It will actually cost the entity something. There are so many costs that can come to the entity because it means that there can be even misappropriation. There are so many costs. You can see, you can suffer in terms of resource allocation. residual losses. Yeah, it can happen to you because what you are looking for is not what the people are doing. So you will suffer. Now imagine that this Universal Institute of Professional Development (UIPD) class that you are in now has owners, and the idea behind it is that the owners want to establish a university. That's the end game, and the university has to be in the name of the university has to be in the minds of people, professionals who has passed through here to do ICA. There's another branch of the UIPD that is doing vocational skills. So that is it. So the owner said, Thomas, we know you are ICA kind of, you are with the ICA, you teach ICA. So we are creating a chapter for you to do CA over here. All right. So the CA is in your hands. So it should get to a point where as the university setups in physical existence, like building, you come there, you are not doing BSc anything. You are doing SIMA. You are doing ICA. You are doing ACCA. That is the Universal Institute of Professional Development. So it will be made up of professionals. And as professionals comes in, you now get accreditation to do the degree courses. And then that is the same structure UPS did, if you remember. And now they are UPS. It's the same structure. Yeah, so that is that. So now, assuming now I decide to look at it only from the perspective of ICA, and I'm not holding the views of the leadership in mind, then it means what is going to happen is that I'll be happy doing the ICA thing and not trying to get to the point where the names are in the minds of people. All that the people are doing is ICA. Now, because of that, the leadership will have to find a way to check what I'm doing. They will have to find a way to check what I'm doing. Because as things goes on, my objective will be different. Their objective is different. Lack of goal congruence. And they will never know because the information is with me. They will never know. So to solve this kind of problem, see, this thing is costing the objective. It is actually costing the mission. Yeah. So to solve this problem, they will bring in, we have two things that we are going to discuss. And that is where it will lead us today. So the thing is that we have an agency cost, and one of the agency costs for us to discuss is we bringing in external auditors. All right, external auditors. And because entities know that there is going to be an external auditors and that the directors will be held accountable because the external auditors are coming in, they also would want to make sure that when the external audits come in, they will not give a report to the shareholders that will show that they are not doing things right. And so they will also come in with internal auditors. Internal auditors. Internal auditors. So you see, external auditors is by the appointment of these ones. But internal auditors is by the appointment of the board of directors. Board of directors. Either way, all of these parties, the board of directors, the internal auditors, which is a representation of the board of directors, and the external auditors, they all hold what we call a fiduciary relationship. Fiduciary relationship. And what is a fiduciary relationship? A fiduciary relationship is a relationship between two parties, whereby one party holds the duty of care to the other one. So the internal auditor holds a duty of care to the board of directors. Board of directors hold duty of care to the shareholders. External auditors hold duty of care to also the shareholders. So that is it. Now, for today's lecture, what I am doing after explaining this thing is to pick the internal audit part. And that is where it leads me to talk about internal controls. Because internal auditors, their main job, the main job of every internal audit is to actually see to it that the internal controls of the business are held or complied to. So we are looking at the internal controls. Now, first of all, you must understand that when these board of directors come in, the board of directors, I've told you that every board of director is for policy development. They develop policy. They regulate. They regulate the implementation of the policy. Then they monitor that the policies are being adhered to. The monitoring eye, therefore, what are they monitoring? The monitoring eye is also this internal control. The internal control is their monitoring eye. Their monitoring eye. So when we talk about internal controls, we are talking about the checks. All right, we are talking about the checks and the evaluations that are done on the systems of an entity to make sure that policies are adhered to. Basically, that is what internal controls are for. All right, so they are meant to do check and also evaluate the systems or the policies that are actually designed by the board of directors, just to see that they are all adhered to. Now, why do we need this? Why do we need the internal control? Why? So the question is that why do we need internal control? And if we need it, we clearly need it because of two reasons. One is that there are risks. There are risks in every business. We call them internal control risk. Internal control risk. And those of you who have been part of my audit class before, I teach that audit risk is equal to inherent risk. So this internal control risk is the same thing as the inherent risk. There are risks inherent everywhere. All right. So because of the risk, number two is that we need the internal control to serve as a system of check. A system of check. A system of check. So we need that. Because as far as every business is concerned in terms of the risk that are involved, and here I teach it as business risk. There are risks inherent in every business, and I classified it in terms of three types of risk. Those of you who have been in audit class, you can mention what are the three types of business risk? Yes, the three types of business risk. I always classify, and it's the same thing we use to solve going concern questions. Yes, anyone, if you are in my audit class, we have done it, you should be able to mention it to me. Yeah. There are three. So what are they? Oh, nobody here is in the audit class. Oh, okay. So we have the financial risk. We have the operational risk. And we have the reputational or compliance risk. Or compliance risk. Now, when we say financial risk is just about your accounting element, the element of financial statement. So we have assets, equity, liability, expenses, and income. Now, anytime your asset is going down, either by impairment, constant repairs, it is losing its value. It is a financial risk. Anytime your equity is going down, it is also a problem because it means you are losing money for future investment. And equity goes down because most of the time your retained earnings or your profit is a loss. So it is reducing, it even comes to a point where it reduces your stated capital. Yeah, so take note of that. So anytime your equity is reducing, it's also a financial risk. If your liabilities are going up, it is also a financial risk. This one, you don't need anybody to explain it to you if you're a Ghanaian. Because when Ghana, we borrowed, and our financial risk went up, we ended up in IMF. And they were telling us that our economy is collapsing. I don't know if you have been hearing what has been going on here from is it Prophet El Bernard? Yeah, he says that there will come a time in Ghana very soon. There will come a season in Ghana where milk is going. Milk is now today. I bought one at 11 cities. Yeah, and he says that a season is coming into Ghana where we'll be buying milk at 3 Ghana cities. 3 Ghana cities. And a season is also coming in Ghana where we'll be shifting. We'll be building new cities, and the cities are going to have big malls. And so he wasn't surprised when he heard that Mahama is talking about a new whole Accra city. It's just a fulfillment of a prophecy. Yeah, it's a prophecy he gave in 2nd January. So what is happening for him is a fulfillment of prophecy. So that is the side of the liability. Now we have expenses. When expenses are also going up, it is a problem. It is a financial risk. Financial risk. Then when your income is also coming down, and income come down as a strategic student, you must know that as competitors increases, your income are likely to come down. And as competitors increases, your expenses are likely to go up because you need to enforce marketing. All right, and all those things. So you need to understand that. So if you have a case whereby you have anything financial connecting to any of these accounting elements, elements of financial statement, and you see the pattern they are going, you should be able to highlight that there is a corporate governance issue, and it is about risk. And the risk we are talking about here is a business risk. All right, it's a business risk of what we call financial issue. All right. Now we talk about operational issues. When we talk about the operational issue, key ones is the loss of key staff. The loss of key staff. And what we call breakdowns, operational breakdowns. So you have idle time. So when you have breakdowns, it's going to affect you. It's going to affect you very much. It's going to affect you. So these are things when you are reading the question, we have to be very vigilant. You have to be very vigilant. All right. These are all corporate governance issues. Then when you talk about compliance issue, we are looking at where you have situation where your brand is being tarnished. So you are not obeying, like, let's say, EPA regulations, GRA regulations. So it's about your brand damage. All right. So that one too, when you see these things in the stories, be mindful of that. Remember, corporate governance is 20 marks in your exam. Don't forget that. Okay, so that is that. Now, so because of this, you need to have a financial control. You need to have an operational control. You need to have a reputational control. You need to. You really need to. You need to. Okay. And so, as a system of check, you need to have a financial control, operational control, and compliance control. And to do that, I am going to use the types of control to actually discuss that. As a system of check, we have preventive controls. Preventive controls. These are policies. Preventive controls are they are made of policies, regulations, like some rules that you put into your business. They are rules. Rules. You put them there. A typical example is you coming to work at 8 o'clock, because if you are not there at 8 o'clock and a customer comes and he doesn't find you, it is going to affect your income because the customer will go to a competitor. Yeah, that is what will happen. We have preventive controls, and there are so many, and I will give you the control activities. It is your job to know that this one is meant to prevent some things from happening. For example, if you do know the reason why when you are writing a check, somebody must sign the check. You know the reason why? When an accountant writes a check, you know I think you should have an idea as to why two people are meant to sign a check in the company. Who can tell me why? I mean, think about it. Why is it that the accountant is not the only person that will sign the check to go and withdraw the money? Yes, why? Why? Why is there a need for a signature to be an approver? Please, let's contribute to it fast so that we can end this class very early. Yes, sir.
Yes, control, sir.
Yeah, it's mainly for control, because me as an accountant, you see, there is a company that I am not a board member, but I am the treasurer. I am the treasurer to that company. Because it's an NGO, we don't say accountant, we say the treasurer. Now, the day the chairman of the board said that he wants me to be a signatory to the company account, I said, "Oh, chairman, it's not a good idea. It's not a good idea. I think any of the board members can do, because I'm not saying I'm going to do something negative, but in this life, anything can happen. There can be a situation whereby I am in so need of money. And given the way my chairman is, sometimes he's always traveling. So sometimes he signs some checks down. So it means that if you make me a signatory to the account, the only signature that is left is me, myself. And if there is a situation, personal situation, I will do before I complain. I will take the money before when you come, I give you explanation, and which is not good for corporate governance. Yeah, that is it. So I told him that it is not really advisable. But it's just that because it's like you build yourself with certain level of integrity. The person said, yeah, it doesn't matter. Even if you are using it for your personal reason, I know you are not going to run away, and I trust you. So you too, it's like you have to make it look like do the things that will not tarnish your image. That is it. But clearly, honestly, you don't need an accountant should not be a signatory to your any company account. So it's a very bad thing. Yeah, for corporate governance purposes. Yeah. Because I when it happens like that, I can manipulate the financial statement for you, the bank statement for you. Yeah. So you do, some people will sign, and when the people are signing, they ask you questions. Why am I paying for this? Where is the memo that I approved that made you write the check? And all those things. Yeah. So these are all preventive controls. So you use policies, rules, and regulations to mitigate the risk. The second type is the detective control. Detective control. And so here the thing is that so like when I'm teaching audit, I tell people that the firms that I consult for, and I have done their financial, I do financial manuals for entities too at a fee. So in every manual I do for every company, I put it there that, for example, after 2 working days after a month, all bank recs must be prepared. All bank recs must be prepared. And that thing I do is detective control. But I tell it is in the financial manual that finance officers are supposed to update their cash book. Yes, you are supposed to update the cash book every day, every day, every day. Because in the office that I have worked in, you will be sitting on your desk and the CEO will come and say, "Hey, Thomas," and these are Nigerians. Nigeria, there, it's like, you have to be on your toes all the time. Oh. You will be there in the office, "Hey, Thomas, how much money do we have in our account? I want to buy dollars." Then you are sitting there. Now, if you've not been updating your bank statement, then right there you are incompetent. That is it. So when I was working in these Nigerian firms, I used to go to work 7 a.m. By 7 a.m., I'm always there. And that's the first thing I do is to update my cash balances. So by 8 o'clock, before everybody comes to the office, I know how much we have in all the bank accounts. And funny, at that time, we had 9 bank accounts. Bank with 9 different banks, so UBA, Access Bank, uh, uh, Sahel Sahara, First Atlantic Bank. There were many. Echo Bank. Like, so you'll be doing these things every day in the morning. Every day in the morning. So when he comes and he says he wants to buy dollars, you give him the update. And when you do that, they really see how competent you are and they really trust you with the work. Honestly, you become very relevant in the office that you are working in. The Nigerian people, they toughen you. Sincerely speaking, they toughen you. So in every financial manual that I do for entities, this is what I also do the same thing. I do the same thing. Then bank rec is done. Now it is to help you detect. So if you didn't do something in the daily ones, if you do the bank rec at the end of every month, so here the control activity is called reconciliation. It will help you to reconcile. You will know the issue. Now, so imagine a company that does not do a bank rec at all. There will be issues. There will be issues. The last type of control here is called the corrective control. And this is where it involves punishment. And this is where it is said that Ghana, we don't know how to do this because of democracy. We are using the democracy, and people are going scot-free, yeah, of breaching controls. Yeah. So these are the types of controls that you have. All right. You can also say financial controls to correct these operational controls and reputational controls, but they are all embedded in these ones. All right. So basically, that is that. Now, so for every control system to work, there are, according to the best practice, the COSO principle, we have 5 elements of internal controls. Elements of internal controls. Please be very mindful of this thing we are doing because it is a current issue that is happening. Yeah, it's a current issue. Myself, I'm doing a research on internal audit, but my focus is on the public sector. Yeah. Because I don't understand why consistently the Auditor General's report says that fraud and misappropriation and everything is happening. Now, if they are happening, how does it happen? And aren't there internal auditors in the entity? So why do they keep happening? So I want to study why these things happen and how to build a robust internal control system by using literature and survey. So maybe I'll send you some of the questionnaires to answer. Survey to gather people's perception about what will make an internal control strong in the public sector because it's a very, very big issue. Every year, the Auditor General report is showing that. All right, so it calls for research. It calls for research, and that is my experimental study. Yeah. So experiential. Sorry. So for every internal control system to work, which will be part of the theories that I will be using, is that there must be one. We need a control environment. Control environment. Now, when we say control environment, all that we are looking at is the leadership, management, those who are in management, their attitude and their awareness towards ethics. That is the problem. Because if the manager, herein, we are looking at the board of directors who are into management, are not really apt for, they are not apt for ethics, forget your internal control. Forget. If they are not up for ethics, forget. Nothing will happen. You can never have proper internal control, will never be adhered to. So the people we put there in management, what is their attitude? What is their awareness? What is their aptitude? I mean, for ethics, because these are the people who are going to do recruitment. And if they don't do ethical recruitment, forget about it. These are the people who are signing the checks. So if they are not really about the ethics, forget about it. All right. So that is one of the things we need for internal control systems to work, the control environment. Now, if these people are there, number two is what we call risk assessment. Risk assessment. Now, when we say risk assessment, we are talking about the relationship between a risk and how it impacts the financial statement. So, for example, if I commit cash fraud, the impact on the financial statement is that my cash balance will fall. That is it. Now, if you are not able to connect that thing into the financial statement, because the financial statement is the communicant, that is the communication that is telling us how a company is performing. So if I steal money from companies, we don't prepare management accounts and financial reports, nobody will know anything. Now, if it also happens, we must be able to connect it, and the financial statement should bring it out that something is happening. If I use office car for more personal use and office fuel, what is happening is that fuel expenses are supposed to go up. So it must tell us something in the financial statement by analytical procedure. We compare last year to this year. This time it went. Have you seen what is happening in the public sector now? That it looks as if every corporation is doing payroll audit. The latest that was in the news today is the CEO of the Cocoa Board, Dr. Randy Abe, conducting payroll audit because he said he doesn't understand why the payroll of the Cocoa Board people is up to 12 million Ghana cedis per annum. $12 million per annum. It's a very interesting revelation that is coming out. Yeah. So that is because he has seen an assessment, risk assessment. So if you're able to do that, it will help more of controls, because I think you heard the story about the University of Ghana too, right? About payroll, right? Did you hear that one in the news? And GES, did you hear that one too in the news? The ghost names. Did you hear of that one, class?
Yes, sir.
Yeah. So these are all issues, and it's all corporate governance issues. So for me, I think it's all because of internal audit. And the essence of the study that I'm trying to do, one of the things is the causative of these things is that we don't have strong internal auditors. And because I want to come from a perspective that the internal auditors are not certified. So if the internal auditors has an accountant in there, the accountant might not be a chartered accountant. So he is dependent, because if you're a chartered accountant, you are bound by ethics. But if you are not, it is easy for them to override you. Yeah. So all these are the things that I'm trying to study. Maybe at the end of the report, when I give it to the people that may be, it means that if you are not a chartered accountant and you are in an internal audit position, you should start securing yourself. Hey, that's the meaning. All right. The third thing that we are looking at is the control activity. And the control activity is basically what you do as part of ensuring control. So, for example, like the check thing that we discussed, we have what we call segregation of duties. It is somebody's job to write the check. It is somebody's job to sign the check. And so there is another one called authorization and approval. So if there is somebody who is supposed to approve that thing, this I remember the is it the MPP or the Attorney General or something taking the form this current finance minister to court that when he was a deputy in some years back, he signed something on behalf of his boss and it caused financial loss to the state and they were chasing him. But when I heard those things, I'm like, but if somebody does something on behalf of his boss, who is supposed to actually be held responsible? Is it not the boss? So why are you attacking the deputy? If the boss came out also to say that the deputy never did anything without consulting him. So why was that thing? Was it a witch hunt or something? I just did not understand that. I just didn't understand those things. Yeah. So these are things that then we have another one of physical control. And the physical control, I think I've given an example for that. So come to work early. And sometimes you will see in the banks, you will see that there will be some offices, they will say restricted area, access to staff only. You see those things, they are all physical controls, all right. We also even have accounting, what do we call it? We have accounting controls, accounting controls. And inside some accounting software, there is somebody who will input the thing, there is somebody who will audit the thing, then there is somebody who will approve the financial transaction. It is also that so that at the end of the day, the financial statement that will come out will be of more of integrity. All right, it will be more of credibility. Another element of internal control is monitoring. And as for this one, I need not to explain it. It's a word we all understand. You are monitoring that the things that are there are there too. So here we look at direction and supervision. Somebody must do that. Supervision. Then the last one is information communication technology. So ICT, how information flows throughout there. Some people use an email system in their offices. Some of them too use chats. All right. Some of them use Teams. Yeah, I don't know, but the offices I've worked in, it is usually emails. It is usually emails. So even when you want to come, some people to also use telephones. Some are even using WhatsApp. They create office WhatsApp group. If in case of anything, they communicate through there. But these systems must work. All right. So basically, that is that. Now, so what we have just done here is to show you. So some of these accounting controls can be under financial controls. Fiscal controls can be including inventory check and all those things. They can also be there. Authorizations can be financial controls, so and reputational. All right, so they all help. Now, the essence of what we have done in terms of understanding this internal control, bear in mind that I've already told you that the internal control is who does the internal controls. It is the board of directors, and I've explained to you why they are doing that, because they want to make sure that the risks are kept, everything is checked, so that when the external auditors who are appointed by the shareholders come to audit them, they have already corrected themselves using their own internal control. So the people in charge of the internal controls are actually the internal auditors. So if I ask you that what is the relevance of internal control, I think it shouldn't be something we should use theory to understand. Per all that we have discussed, internal controls are very, very important, because without it, oh my goodness, the cost that will come to an entity is worse. It's worse. So the people who are supposed to make sure these internal controls are working, as these internal controls are designed by the directors, the people who are supposed to make sure that these internal control systems are working is the same board of directors, but that job is carried out by what we call the internal audit. And so that is the next thing that we are looking at, the internal audit. And the internal audit is formed by the the audit committee. The internal audit is actually formed by the internal committee. So let's discuss the audit committee. So let's discuss the audit committee. But that one, permit me to go to use my audit book to actually for us to discuss that. All right. So what we will be discussing will be number one, the composition of internal audit, the objective and functions of internal audit. All right. And we will also be looking at internal audit as a function of corporate governance. All right. As part of internal control. Okay. So let's see. Let's see. Any idea? Who has an idea about the composition of internal auditors? The audit committee. Any idea about the composition of an internal audit committee? If you have passed audit, this is something you should know. Any idea? The composition of internal audit committee. Good. This audit committee. Yes, any idea at all? Because this one is a discussion we are going to do, and we will end it by talking about the role of an accountant in corporate governance for this part. Yes, any idea? First of all, when we talk about internal audit, we are talking about a representation of the board of directors who are supposed to make sure that the internal audits, all right, or the internal control, sorry, are actually adhered to, so that it will reduce the risk. So that is the essence of an internal audit, audit committees. Audit committees. Now, so the objective of the audit committee, as you can see here, is that they are supposed to enhance credibility of the published financial statement. If the audit committee do their work well, the external auditors will have minimal issues to bring out. So I believe that we should focus on our internal audit, which are appointed by the internal audit committee, more as a nation. As a nation, we need to, because those are the savers. And as part of them pushing it, I think you should by this time hear of the Ghana Internal Audit Bill, which hasn't yet been passed into law. Yeah, that thing was there in the old administration, and since government changed hands, I don't know what is going on now. Yeah. So they are supposed to enhance credibility, and they are supposed to assist the auditors in carrying out their the directors, especially the executive directors, in carrying out their responsibility of preparing financial statements. All right. So basically, that is that. Then number three is that these people strengthen the independent position of the external audit by providing them with additional channel of information. Because if the internal audit in itself, as established by the audit committee, they don't report to the executives. They report to the non-executive, because audit committee, as you see it, are made up of non-executives. And you saw it in the first video that I did for you. They are they are made up of all non-executives. And the minimum they should be is 3 people. All right. But in smaller companies, you can have 2. But the chairman of the general board of directors should not be part of that. And at least one of the members should have relevant financial experience, meaning that we should have a chartered accountant representation in the audit committee. We should have such. All right. So that is that. And the others should also be very competent in terms of the industrial knowledge. So ask yourself, the way the government is appointing board of directors for certain institutions, do you think that those people have relevant knowledge in those areas, or is just job for the boys? That is left for you to uh, discuss. All right. So that is the composition of audit committee. Of course, they are supposed to be resourced, and they are also supposed to make time. They are supposed to meet a minimum of 3 times a year. So you see, if a GRA officer, all right, tells you that as you have established a company, every company must have a board of directors, and the board of directors must meet. They must have a meeting, and when they have meetings, you are supposed to pay board fees. Board fees. And so board fees attract a withholding tax of 20% for the non-executive directors. But for the executive directors, the board fees is added to their salary. So it passes through the payee system. So for your information, never pay 20% tax on a CEO who is part of a board. Never do that. Never do that. People do that a lot. If the person is an executive director, when he goes for a meeting, the money is part of his payroll. So add it to his payroll salary and use the graduated tax system to tax him. It is the non-executive directors. We use the 20%. So when a GRA officer wants to bully you in that thing, I mean, stand on your grounds. Stand on your grounds. All right. Yeah. Sometimes for them, so far as they went for a board meeting, they said produce. And even if they don't do the board meeting, it is by law, you are supposed to have the board meeting. So that is where the GRA people will apply a deemed board fee on you. They will say you did the board fee. You are supposed to pay. They look at the caliber of your board and they will determine how much you were supposed to pay the board, and they will deduct their withholding tax, 20%. Yeah. So those are things that happen. All right. So that is it. That is it. So their roles, as you can see, is the same as their objective. Monitor the integrity of the financial statement, provide advice to the board of directors, review the internal financial controls and the internal controls. Review it. Reviewing it all the time so that, the world is developing into automation. So things must be reviewed. You can't keep old ways of controls when the world is going automation. That is why coming to the office and writing your name in the notebook and the time you come to the office, that thing by this time should not be anywhere in our society anymore. But when I went to public sector, I went to the Department of Social Welfare. I went there. In fact, I was looking for something to press. Apparently, there is a notebook that is there that I'm supposed to write my name and put in the time. And it's funny because I went there 8 o'clock. 8 o'clock exactly, I was there. Unfortunately, the person to even open the notebook for me to write, he has not come to work. But he will come and put the 8 a.m. there. He will come and do that. Yes. So you must review and monitor, all right, the effectiveness of the internal control, all right. It is the audit committee that will develop those internal controls. Like I said, they are part of the board, so their job is to design, implement, monitor, and review the thing's effectiveness, all right. So basically, that is that. They review the effectiveness of they even recommend the external auditors, which external auditors the board should go ahead for. All right. So their appointment, reappointment, their removal, they make recommendations for that. All right. So that is the function of the audit committee. It is good to have an audit committee because it increases confidence, and if they do their work well, you realize that it reduces the risk that comes in the financial statement. All right. So that is that. But it is also difficult because selecting those people to be on the board audit committee is not an easy thing, and you pay them too. They don't do free job. You are supposed to pay them. All right. So that is that. An annual report must show the work of the audit committee. Every annual report must show it. It's part of disclosures. All right. It's part of disclosures. The number of meetings, the qualifying people that are on that committee, the number of meetings that they held. All right. And all those things. Okay. So basically, that is that. That is it for the internal, the audit committee. All right. So basically, that is that. So let's come to the last bit of this part, the role of the accountant in corporate governance. The role of the accountant. The role of the accountant in corporate governance. What role do accountants play in corporate governance? These are questions you should expect because you are becoming accountant. What role do they perform? First of all, remember, the accountants are employed by the board of directors. So they actually prepare financial statements, and that is it. When they are preparing the financial statement, they are meant to comply with the financial controls. That is it. That's the impact. Comply with the financial controls. What are some of the examples of the financial controls? Told you that authorization. Some people will enter the thing. Some people are supposed to audit. Some people are supposed to approve the thing before it hits the trial balance. The thing hits the ledgers. Financial controls includes the reconciliations that you must do. Ledger reconciliation, aging reconciliation, cash and bank reconciliation, receivable reconciliation, all those things, they are all part of financial controls. Even inventory checks, they are all part. So that the closing balance of the inventory that you put in your books will be a correct thing. So you are meant to comply. And the truth is that in every board of directors, there must be the presence of a financial director. Yes, financial director. Every board must have. So you must have an accountant there. So accountants are present in the board system, which is corporate governance. Accountants are also present in audit committees. The audit committees, I told you one of them should at least be an accountant, have relevant financial reporting knowledge. All right. And as you can see, the accountant advises the board because they are part of the audit committee. They advise the board. All right. They advise the board, and that is their presence, their impact. Another thing that you also see is that even the external auditors, they are accountants. Because according to section 138 of Act 992, accountants auditors are meant to be chartered accountants. So accountants are the external auditors. They are. In fact, even in internal auditors, like I'm saying, I am advocating that internal auditors must be accountants. Must be accountant. Now, if you are not an accountant, when somebody is not, it's funny. Look at this situation. The finance department in a business are chartered accountants. They are. But the internal auditors, they are not chartered accountants. So if they are not, how do they know the IFRS to actually check the finance people who are chartered accountants. Does it make sense? It doesn't make sense. Can never make sense. Because one thing you should understand is that when it comes to internal auditors, they have two major functions. They have internal audit function. They have internal check function. There's a difference between internal check and internal audit. Internal check is you checking the thing before the transaction happens. And the internal audit is you auditing after the transaction happens. You know, audit is an independent examination of something that has already happened. But internal auditors perform also internal check. So I remember in the Nigerian office, there was a woman, and I remember that woman very well. It's called Adejoke Olatunji. Adejoke Olatunji. She is not an accountant. But when I was going to work in that Nigerian firm, she was the first person who interviewed me. And I remember that experience a lot because my interview was about when I sat down, we did the normal chat, and she asked me, what is the useful life of a car? If a company buys a car, what useful life are we supposed to give to that? And you know, that's my first job interview ever. And I was coming from Kumasi. As for Kumasi, if you buy a car, you want to make sure that the car lasts for long. So when she asked me, I think I quoted 10 years. She said, hey, 10 years. Why? My friend, how can you give asset 10 years useful life? A car, 10 years useful life. Google it. It is not 10 years. Google it. Google it. And when I Google it, they gave me 4 years, maximum of 5. So the woman said that, you know, so you've seen, this one there, it looks as if you don't know. Then I told her that I'm an accountant. And according to IAS 8, accounting policy change in estimate and errors, useful life is an estimate. And nobody can fault anybody on an estimate. As a matter of fact, even if even if it is a policy, the standard says that where there is no policy, an entity must have its own policy in line with the conceptual framework. And I knew that I should have added industry practice, but I didn't add that one. I just kept to the fact that it is an estimate and everybody has a prerogative of using his own estimation. So when I was quoting IAS 8 and those things, the woman now realized that it looks as if social media is not the way to go. Accounting is based on standards and we use standards. So I saw her nodding the head and I realized that I've gotten the woman over there. So I stuck there and explained IAS 8 and used that one. Then she now approved of me. Now this same woman, whilst I was already about 2 years or so on the job, I've been filing my GRA withholding taxes. That time, we submitted it to the GRA office, so it wasn't something online. I prepared my schedule. Even my boss doesn't look at my schedule because my boss is a Nigerian. He doesn't understand the Ghana laws. So everything was left to me as far as tax is concerned. I was my own boss. Then I prepared the thing, and this woman at the joker said that I should bring my schedule for like as he was like an internal auditor to check. When I brought it, I brought it to her. She said she doesn't understand this, doesn't understand. I said yes, that is the tax law. So as an internal audit department there, you are supposed to know these tax laws. If you ask me to explain it to you, then it's as good as not wasting my time because I will explain the thing to you to suit myself. Yeah. So internal auditors, you must have an accountant there. You must have accountant there. I always tell people it is a shame for an accountant to do something, for a non-accountant to draw his attention to errors in what he did, it's actually a shame. You don't need to put yourself into that situation. All right, so this is how accountants are supposed to impact corporate governance. So, ladies and gentlemen, this is the end of this session. Your job is that in the case, you are supposed to identify any corporate governance issue. Identify the corporate governance issue in the case. So from the first video that we did, the composition of board of directors, they are everything, and today to everything about internal audit and internal control and audit committee. Find out what the company has not done well. So find out the problem that is in the case. Number two is that you are supposed to explain what is the best practice of corporate governance stand on that issue. So for example, you are reading a case, you realize that in the board of directors, the structure, the executive directors are more than the non-executive directors. This is not a best practice. So that is the problem. So you will say identification of the issue, you will say the executive directors being greater than the non-executive directors. Now, what does the best practice says we should do? What does the best practice say we should do? What are we supposed to do? What is corporate governance best practice saying about it? What is it saying about it? So you have to quote what corporate governance best practice is saying about it. What best practice is saying about it is that there must be a balance between the executive directors and the non-executive directors, with the chairman of the board of directors being a non-executive director. So technically, if you look at it, the non-executive directors are meant to rather be greater than the executive directors. So when you quote the best practice, then lastly, you give your recommendation. Your recommendation is to follow the best practice. So you are supposed to say that they must have more non-executive directors than the executive directors. All right. So that is how you answer the question. And we will be practicing that in pre-scene cases. We will be looking at when we are examining, when we are giving the case. You see, per what I've taught you and corporate governance being the end, you remember what I have been doing. I told you that when you have the case, you are meant to do strategic position analysis. Strategic position analysis. And please, the strategic position analysis, it is 40 marks, including corporate governance. 40 marks. So the strategic position analysis that you are doing environmental analysis. And the environmental analysis, if you remember clearly, we did a macro environment. And the macro environment, you did PESTEL, if you remember. So you are going to answer in the PESTEL model. And we did the industry analysis. In the industry analysis, what model did we use? Who can remember? What model did we use to analyze industry analysis? Come on. Yes, what model did we learn?
The Potter's five forces.
Potter's five forces. We will do another one, which is the Potter's diamond, but I will do that one in international strategies. So you do environment and environmental analysis. Then you must also do, we also talked about, apart from the environment, we also talked about, what do we call it? Resource and capabilities. You remember that, right? And the model that was dominant about that place was which model? Which model was dominant there? Do we use to do resource and capability analysis? Which model?
VRIO.
VRIO. So those are the things that you are learning. Not only this, we also discuss what do we call it? The concept of, so this one was an internal analysis that we are doing. So the strategic capabilities. Then now we are doing, so before I even come to what we are doing now, we also did history and culture. History and culture. And the history and culture, I told you that where the examiner likes the most is what? The most examinable area there is what? I said it.
The
It's
culture.
what? The cultural web. You remember?
Yes, sir.
Yeah, a cultural web. So take note of that. Take note of that. Now, the last one is what we call the stakeholder analysis and governance. So stakeholders and governance. Stakeholder and governance is the last one. And so all that I've done now is to talk about the governance. Now, the next session, which I will pre-record for you, of course, because I'm ending this one for today, which I will pre-record for you. I think by tomorrow morning you will have it. I'll probably do it tomorrow dawn. It's what we call the stakeholder. Even the stakeholders, if you watch the first video of corporate governance, I discussed the stakeholders where I told you to remember what you used to do in basic accounting. The users of financial information. Those are the stakeholders and their information need. That is it. It's the same thing. But I will go deeper to talk about some theories. The stakeholder theory, I will be discussing the stakeholder theory. I'll be discussing the transaction theory and some few theories of ethics. So when that one, but the governance alone, and I'll be discussing corporate social responsibility. Yeah. So that one adds up. So everything that we are doing here is 40 marks. So 40 marks. Then the financial management part, you will be joining me on Wednesdays for, and that one too. The videos are already there. If you I will share it on your platform so that if you are not able to join on the Wednesdays, you can just straight away be watching those videos. But as usual, they are listed on the YouTube channel for you already. All those things are listed on the YouTube channel. If you can find my financial management playlist, so if you go to the YouTube channel, all right, so you type Thomas Ansan on YouTube, it will pop up. I think the internet is slow a little. So when this thing pop up, you come to the playlist. When you click the playlist, you will see financial management here. So you click on financial management. So take note. You see, imagine immediately I clicked on. You saw
when you write,
things
your tone influences how
we
readers
discussed
respond.
today.
With Grammarly, just highlight your text and type.
You saw the thing that I was discussing today, shareholder wealth maximization. You saw it. You come to this, all right. And that is the next thing we will be talking about. So those things are there. It tells you the objective. Now, for a case study student, when you finish watching this part one video, you are supposed to, the next video you are supposed to jump to, the next series of videos you are supposed to jump to is this one, business finance, cost of capital, so business finance, from business finance to the end, is all part of case study. From this business finance to cost of capital, because you'll be doing that business finance work, but you are not supposed to be watching these past questions because yours is more theoretical and a fewer calculation. So business finance work part 1 and 2, you can add the part 3. The part 3 is FM past questions that I was solving for them. All right. Then you look at capital structure. This one is dangerous. It's dangerous for your exams. You are supposed to do that. But I will be doing it again with the FM class. So you can also, that is the Wednesdays. Then business valuation, acquisition and merger. As for business valuation, you know, if you're a level 3 student, you also do it in corporate reporting. You know that. So you'll be doing that. Acquisition and merger. And what the case study people don't like, risk management. Whether you like it or not, it is there. So in some of the case study questions, you'll be seeing some things like options, swaptions, LIBOR, landing interbank borrowing rates. You'll be seeing those things. You'll be seeing those things. You'll be seeing things like swaptions. You'll be seeing things like forward agreement rate. You'll be seeing things like what do you call it? Features on market hedges. So you'll be seeing all those things. You'll be seeing all those things. All right. So all these things are for you. All these videos are for you. So if maybe your Wednesdays are tight, you can be using this one to actually stay ahead of us. All right, you can be using this one. So for every case study, you must do this one. I think that this is your ICA book. I was just looking at it. So Cornelius, you can check because this is the old one. And you will see clearly, you will see something like this: financial management, sources of finance, capital structure, investment decisions. These are NPV analysis. Investment decisions, NPV analysis. All right. NPV analysis. International financial management, international NPV analysis. So we are supposed to do all these things. We are supposed to do all these things. Treasury management, that is what you see there. That is this one. The risk management, we call it treasury management. So this one, the corporate governance, all these things we have touched upon it. Financial report, we have done all these things. All these things we have done it. That's what we've done in the corporate report. So from this one, the financial management aspect, that is the part one you are supposed to know. Sources of finance is business finance. This is it. This is the video for it. Business finance. Capital structure decisions. This is it. Capital structure decisions. All right. What else do you see? Investment decisions. So this is investment decisions. Where are you? Investment appraiser, basic investment appraiser, advanced investment appraiser. All right. So these are all investment decisions. Okay. So it's an FM aspect, but you see the problem is that when you get the exemptions from level 2 and you are doing the level 3, you have skipped all these things, and because of the nature of case study, if you don't get somebody who teaches financial management and man accounting, you will be doing only the strategies and the theory aspect of it. That was all that you'll be doing. You'll be focusing on BCG matrix, ANSOF, PESTEL, VRIO, and all those things. But that thing is just 40 mark of the exams, including the corporate governance. The 60 marks is there in terms of the strategic choice. And that is where you do all those other strategies, the strategic choice and the strategic implementation. So that is where most of the marks are. All right. So we need to understand the FM. So if I am you, and maybe I'm left with corporate reporting and case study to do, or I'm left with only case study or something, I will be ahead of time. Yeah, you can be ahead of time. All right. So, ladies and gentlemen, this is it. I will do the other theories for you. The agency relationship. I think even the agency relationship, I've explained it, and the agency theories, I've explained it. So, my focus more is going to be on the transaction cost theory and the stakeholder theory, where I'll be discussing the corporate social CSR. So, and that thing too is a general knowledge thing you already have an idea about. But I will do a short video on that and I'll send it to your platform also. All right. So what I'm going to do, this one I need to put it off camera. Yes. People are interested in these things. They have to join class. It's very important. So thank you for this class, but I'm going to do something off camera.